It's Robert Miner with Dynamic Traders Group with this week's short video for our YouTube subscribers and Twitter followers. Haven't done a video for a couple weeks. I hope you took the information seriously from a couple weeks ago with the S&P because it's been dead on and nothing's really changed. So you might want to review that video from a couple weeks ago to get an idea of the probable trend of the S&P over the next couple of weeks or so. Today we're going to take a close look at the dollar index because I think the dollar index is in a really interesting position, not only for, let's say, longer term trades, but since all of the financial markets around the world are affected by major dollar trends, and I think we're having a shift in a dollar trend this year, is something you really want to be aware of and take advantage of. So let's get at it. We'll do a brief look at the major dollar trend that I think is coming up. If you want more details, you know what you need to do. You need to check us out at dynamictraders.com. I just did about a 20-minute video with a written report for our subscribers for the dollar index. And I think that alone is worth the price of a 3-month subscription, but I'm a little bit prejudiced about that. Okay, let's get started. Take a look at the dollar index. This is the dollar index monthly chart, and I'm showing data beginning around 2008. There was a major low in 2008. Let's just take a look at this advance since the 2008 low. This is pure textbook Elliott Wave. In fact, it's a little scary. It's too perfect, but we got to take a look at it and recognize what is the probable position of this dollar index right up to date as of the time I'm recording this on Saturday, February 25th. Off of the 2008 low, we had a nice 5-wave advance for a wave 1 high, and then a ABC correction, and then 1, 2, 3, 4, 5 into January 2017 to complete what we call a wave 3, another ABC correction, and then an advance to a new high for probable wave 5. Now the high that was made near the end of last year in September was made at 2 very significant price relationships for what I call an end of wave 5. Those two relationships were the 162% external retracement of the wave 4. That's a typical target for the end of a wave 5. And also the 100% alternate price projection of the wave 1. Again, a very typical end of wave 5 target. When you get 2 or 3 different structural relationships and one of the high probability price relationships for a target, they fall close to each other for an end of wave narrow price zone, they're very powerful. I developed this almost 30 years ago. I call them end of wave price target zones. And there's very specific price relationships for different parts of whatever structure you're looking to identify what is the probable target zone for it. So what we can say as of now, as of late February in 2023, that, and listen to my language, it's very important how I phrase this. Now, as of September 2022, the dollar index was in a position to have completed a 5-wave impulsive bull trend that began all the way back at the 2008 low. That's really significant if indeed that end of wave 5 and bull trend is complete last September. If that's the case, then at a minimum, we're going to see the dollar index sideways to down for several years. So that will really strongly influence a lot of markets all around the world, almost every market for that matter. So it's something you should be aware of, and I know I have a high percentage of international viewers on these YouTube videos, just as we do with our DT reports. So it's not just for the U.S. is this important because it's the dollar index, is because the dollar is a reserve currency of the world. And if it's sideways to down for several years, and that doesn't mean it's going to go away, but you know the dollar index has multi-year trends up and down just like every other market, but it's going to really have an effect on many other markets. Let me take a look at, let's us take a look at the weekly data, and the weekly data I'm just showing from the January 2021 wave 4 low into what is probable a wave 5 high in September. So let's look at this decline off of the September high. This is what we call an impulsive trend, and a correction should not be complete on an impulsive trend. I mean, this is just textbook impulsive Elliott Wave trend. What this should be is a wave 1 or A decline. It should be followed by a wave 2 or B correction, and then a continuation of the bear trend to a new low. Now, that's just what would happen over the next few months. I believe it's a wave 1 of a much higher time frame bear trend than just a simple ABC that's going to last a few months. Why is that? Well, that's a lot more details I share with our DT Reports subscribers. But for right now, let's just take a look at what is the probable outcome and trend over the next few weeks. If indeed this completed a 5-wave decline, and if indeed the dollar index is making a correction, the correction, a wave 2 or B correction, usually reaches around the 38 to the 62% time retracement of the wave 1 array. That brings us into the week ending March 24th through the week ending April 21st. So more than likely that would mean another about 3 weeks at a minimum sideways to up for the dollar index, and that's a trade in itself you can consider. But then sometime around the latter part of March and the latter part of April, this corrective advance would be complete, more than likely at least, and it would more than likely reach at least the 50% retracement. That's why it's the only really retracement that I have on here. We can narrow down that price target zone as the weeks carry on, if indeed the dollar is sideways to up. But that's a minimum expectation for this wave 2 or B correction. 50% price retracement, 38% time retracement. And so if the dollar happened to do that and be sideways to up in that latter part of March, we'd want to be really alert to the position of the dollar to complete a corrective advance. And if we can identify that, then more than likely what will occur after late March to late April would be another decline to a new low. So that's what we're looking at just in the next few weeks with the dollar index. And it just happens that this 38% time retracement is in the same week as the next Fed announcement. And of course, the dollar index frequently makes reversals around the Fed announcement. So we just keep that on our charts so we're prepared for that. I'm going to go to a quarterly chart of the dollar. Each of these bars represents a quarter or 3 months. And this is data going back to the September 2001 high, which was followed by just a nice 5-wave decline. Now that's 7 years of data, keep in mind. That's a long bear trend in the dollar, which then 2008 began this significant, what's this? This is a 14-year 5-wave bull trend, which is probably complete in September. So if that's the case, the minimum expectation for the dollar index sideways to down would be beyond September 2026. Why is that? If the dollar was just making a correction to this advance, is that correction should be of a higher degree and greater in time and price than any correction within the bull trend. In other words, greater in time and price than a wave 2 or a wave 4. Wave 4 is obviously the longer of those two. And 100% alternate time projection of wave 4 from the September high is September. It's the third quarter of 2026. So again, the minimum expectation, if indeed this is an end of wave 5 in the September high, would be for 3 years sideways to down for the dollar. The more probable would be at least a 38% time retracement, and that would take it into 2028. So that would be a 6-year or longer net bear trend for the dollar index. We have some other time factors, but this just shows you how significant this decline could be with a minimum of 3 years sideways to down. And it's not the end of the dollar by any means. We can look back from 2001 down to 2008. That was a really significant 5-wave bear trend, and the dollar lost over 40% of value in that 7 years, and then continued to advance over the last 13, 14 years. But this is what we want to at least be aware of, this possibility. And then we go down to our weekly and daily data to see week by week if this September high is confirmed. I'll go back to the weekly. If it gets confirmed, that weekly, confirmed as the end of wave 5 high, and that's part of what we do in our reports, of course, is when we look at a high probability position of a market, then we identify, okay, what should the market do and what should it not do if whatever this assumption is correct. So that's what we'll be looking at in the months and really years ahead. But for the next few weeks, probably sideways to up for 2, 3, 4 weeks, and then would probably complete a corrective high sometime around late March into April, followed by a resumption of this weekly bear trend to a new low below the February low. So that's the immediate trade setup, but you want to be aware of the long-term potential reversal into a bear trend over the next 3 years or more. Well, that's it for today, my friends. Thanks for checking out these YouTube videos. Go to dynamictraders.com, sign up for our DT Traders news service. It's absolutely free. We have a few more updates than what we have on the YouTube videos that might be helpful for you, as well as some additional education. So check that out. Check out our DT reports. Thanks a lot for checking the YouTube videos out, and I'll be back again for a week or two. Make sure you subscribe so you get notified when the next video is posted. Take care. Robert Miner over and out for now.